Mandela Hotel was a winning group from class 11 and 12. Our team consisted of 2 people in pricing, Ju and Liv, followed by 2 people in marketing, Jean and Timon, and another 2 in refurbishment and investment division, Nora and myself. These 2-person teams ensured a knowledgeable replacement if anybody happened to miss a session. The main point which contributed to our success was a direct link from one member of our pricing team into each of the other divisions. Any change was therefore came directly from the change of price, from our communication with the pricing team. The Mandela Hotel is an 8-year-old 3-star hotel with a book value of 31.25 million. Facilities include 50 premium rooms, 200 standard rooms and 125 cover restaurant, accompanied by an adjoining bar and lounge. Furthermore, the hotel boasts a 2,000 square foot conference room, an outdoor pool and a recreation area. Services include parking ramp, telephone services, laundry and dry cleaning for the guests. Also, guest room digital entertainment and room service. The hotel had experienced steady performance decline over the past few years, hence the introduction of our team's management. Regarding our positioning, we aim to capture those who would seek an economic business hotel. This was achieved by a better than average quality, with good technological facilities regarding our pricing. We decided to go for an undercutting strategy, therefore aiming just below the average market price.
Mandela Hotel target segments are bar standard and large group. Thus it was more logical for us to market during the weekdays. That is why on the $111,500 spent on marketing, we spent 75% on weekdays. Our marketing focused on weekends only during the summer, where our weekends occupancy was higher from 5 to 10% compared to the weekdays. Considering the target segment we marketed on, we spent 65% on transient, 5% on discounted and 30% on group. However, our revenue on each channel is pretty close, with 36% from transient, 30% from discounted and 34% from groups. We made a few tries in the beginning of the year, changing the channel we marketed on, but we saw little impact. Our return on marketing invested per segment is shown in the graph right there, but has to be interpreted specifically. Since our team decided not to market on discounted, only 5% of total marketing expenses, the turnover on marketing investment of discounted is really high compared to the 2 others. As you can see, for each dollar we invested in marketing, our hotel benefits from $92.22 revenue.
As shown in the graph, the distribution channel that generates the most revenue for Mandela Hotel is the direct distribution channel, followed by GDS, OTA and wholesale. It is positive to see that the direct channel is responsible for more than half of the revenue, as this is the channel with the highest net rate. To be honest, however, we also have to say that we expected this and we hoped that this would happen, because we put our marketing focus on direct bookings. Why? Well, past data on channel demand and transaction costs showed that bar standard business travelers and large groups, being our target market, prefer direct bookings. Consequently, we focused our marketing investment on that distribution channel. So these graphs combined show that our marketing was successful, as our guests were booking through the channels we were investing in the most. But how effective was our marketing finally? If we now look at the return on investment, or in other words, at the turnover on marketing investment, we can see that the graph looks exactly the other way around. So direct bookings actually have the lowest return on investment. But what does that mean? It means that the more we invest on marketing, the less revenue we generate per additional dollar spent. So finally, marketing investments are not that effective at all.
We actually realized quite early that marketing had little impact on our occupancy, and thus we reduced our marketing expense through the year, as the trend line of that graph illustrates. There are 2 anomalies: March, because of the request group proposal that really changed our marketing, and September, because we wanted to keep the high occupancy we had from the summer. We usually spend all our marketing expenses on only one segment, and yet we still had a marketing index between 7 and 9 out of 9 on the segment we marketed on. We understood the other groups who were marketing heavily compared to us, and since we did not plan on greatly increasing our marketing expenses, we decided to start spending so much, especially since we diagnosed a lack of marketing effectiveness.
Here's a timeline representing the year, aiming at showing the overview of the happenings and events that occurred during the different quarters. Starting with the first quarter, our main objective was to get to know the market and gain enough market knowledge to effectively be able to implement our price strategy. Our first price that we implemented in January was based on the previous data we had on paper and making an undercut from the prices presented in each different categories. The following months we based our pricing on the average of the hotels in the concept and undercut from there. We also had our first RFP in this quarter. Moving on to the second quarter, we experienced a gradually growing demand and an increase in net profits. We kept undercutting the average price of our competitors, keeping in mind that the demand was increasing, and thereby we tried to estimate by how much everyone would raise their prices and in order to adjust accordingly. We had our second RFP that was shared with another hotel in this quarter. Quarter 3, the highest season. Here we tried to raise our prices not to miss out on any profits that could be made due to the high demand. We experienced a bit of a difficulty in estimating the reactions of our competitors, and for certain months we ended up with a slightly higher price than what was optimal for our strategy. In the fourth quarter, demand quickly decreased. We struggled with trying to forecast how drastically our competitors would lower their rates, and in some months we had a bit too aggressive pricing strategy, resulting in a loss in the market share to our competitors.
As we are implementing the undercutting strategy, we strive to estimate the market price in advance and undercut slightly from it. Hence, in general, we expect an ADR index slightly below or equal to the market index, a penetration index above the market level, and a RevPAR index above the market level as a sign of good hotel performance. As shown in our yearly market index chart, our RevPAR index is 10 times over the market level during the year, which shows our overall better than market performance. Our ADR indexes are not always kept at a slightly lower than market level due to the difficulty in estimating the fluctuating market price. Also, the indexes vary largely from the market in March and May due to two acceptance of requests for proposal. The ADR indexes of these 2 months are hence dragged down by the bidding price offered to the group request. In the yearly revenue and profit chart, we can see that the third quarter is the most important quarter for us because it is the high season and a huge demand is generated. This pushed our hotel's revenue and profit to the peak of the year. We had generated loss in January and February due to the low demand and occupancy. But starting from March, we are generating increasing profit all the way until August, and then slightly decreasing until December. The GoPAR moves in the same trend.
Quarter 1 report. So for the pricing, as mentioned earlier, we practiced an undercutting strategy. Our average ADR for this quarter is remarkably below the competitors. And as you can also see in the price value map, our price is below the majority of competitors. Our goal would be to be a bit closer to the market average, just undercutting, not penetrating. Furthermore, we accepted an RFP during March. To calculate our rate, since we were in the low season with low to non-displacement, we used a zero margin calculation that covered costs, and then we put a slight markup on top of that price. The effect of accepting this group can be observed on our indexes. In March, the MPI is very high due to the high occupancy, the ARI very low due to the low rate, and ultimately a high RGI, meaning that what was lost in ADR was made up for in occupancy. We also experienced a high net profit during March, and that was actually the first month that we made a net profit instead of loss. In terms of refurbishment, we redid the soft goods for several departments and facilities. Quarter 2. Here demand is steadily increasing month by month. We still practice our pricing strategy, and looking at the indexes of April, and more specifically June, we're doing very well, with above average performance in occupancy and RevPAR, and a slightly lower ADR than the market. In May, we accepted an RFP that got divided into 2 and split between our hotel and another hotel. We calculated our MAR with the displacement method. Still, since the demand in this period was quite low, that resulted in a relatively low displacement of transits and thereby a low MAR. However, when the results of May were in, we realized that we were not able to generate enough occupancy in order to cover the loss in ADR, and our indices for this month are very low. This was partly recovered in June, when we obtained a great net profit, and our indexes were aligned with our goals. In terms of refurbishment, we redid the soft goods similarly like the previous quarter, and a renovation of the front desk, and we started with one of our contracted cleanings in order to have attractive rooms for the upcoming high season.
In quarter 3, we implemented the undercutting strategy, and our average ADR is 190, which is slightly above the market level due to the overestimation of the price increase in high season. The demand on weekend also exceeded the demand on weekday, so we adjusted the rate bucket regarding to this change. The overall performance is satisfying since the RGI is above the market level for the quarter. We have also been generating good revenue and profit during the third quarter. Only the penetration index has gone slightly below the market average in August due to our overestimation of the market price. Therefore, the higher than market ADR drives down the occupancy relatively. In July, we received a request for proposal. As it was in high season, we used the displacement method to calculate the minimum acceptable rate and provided a bidding price for $159, but it was not accepted. Nevertheless, the request for proposal increased the demand for other hotels, and we also adjusted to match this increased demand by moderately raising the price, which is represented in our ADR. Besides, during the third quarter, we did not want to do huge refurbishment or put any rooms out of order to maximize our rooms available. Hence, we only focus on contract cleaning for different kinds of hotel facilities to increase the quality rating from the customers. The result is satisfying as shown in the value mapping that we had a higher than average quality and a price matching the market level, which is very close to our ideal positioning, the quadrant 1. In quarter 4, we kept our undercutting strategy, but we did not do a great job in pricing in November and December. The drastic market price decrease from October to November drives down our hotel's occupancy, since we are not lowering the price at the same speed. While in December, we undercut too much from the market price, which turned into a bad sign for our customers, and our RGI goes below the market. Our rate buckets were readjusted since we do not want to drive away valuable customers with our rate tiers. We have received another request for proposal in November. We calculated the MAR with the displacement method and provided a bidding price of $83, but it was not accepted by the group. In this month, we decided to set the price exactly as the price before, as we estimated the increasing price due to the request for proposal would be offset by the decreased price brought by the overall reducing market demand. This quarter, we have focused on redoing soft goods and some simple cleaning for lobby and guest room standard. As shown in the value mapping, we finally stayed in our ideal quadrant 1. This shows that we are generally matching very well to our value proposition of higher than average quality and lower than average rate.
So concerning our recommendations in the short run, we want to keep on doing price undercutting as it has shown great success in the last year. Furthermore, we have learned from our mistakes in the previous year, and we can improve. We had difficulties in estimating the market price, especially after high season. We didn't anticipate our market price well enough as our competitors lowered the price more drastically as we forecasted. As a result, we did not manage to undercut. However, we have gained a better understanding of our customers and market behavior, and with our historical data that we have collected by today, we're able to better forecast. We can improve our trigger points and further implement a more successful price undercutting. Concerning marketing, as my colleague Timon mentioned, our marketing was successful but not as effective. In other words, the more we invested, the smaller was our marginal contribution. Therefore, we plan to lower our marketing expenditure. So for groups, we would like to still keep a close relationship with them, and especially during the first quarter last year, our group RFP significantly increased our RevPAR and net profit. For the long-term objectives, we would like to undertake a significant investment of building a business center. As we target mainly business clientele, we are confident that this investment will help us attract more guests. Furthermore, smaller refurbishments of our standard premium guest rooms are planned in order to keep our quality on a good level.
As a great man, Nelson Mandela once said, "I never lose, I only learn and win."
Mandela Hotel did both.